Trading a single share is easy. Pick a stock, choose your broker, then pick up the phone or log into a website to place your trading order. But trading the entire market or even a sector isn't as simple. Let's say you want exposure to a country's entire market, or you think some macro drivers will play favorably for an industry, and you want to trade the entire real estate sector, banking industry, energy sector, or any other industry. You can pick a handful of shares in those sectors, but how do you build a diversified portfolio across the entire market? Until recently, you had three options. Sort through all the listed shares in your target market and build your own portfolio. Pay a portfolio manager to do it for you. Or go to a mutual fund and accept limited liquidity and only learning what your top holdings are once a month or so. Now, imagine there is a product that allows you to trade an entire market or sector at once in a simple and cost-effective way. A single security that gives you exposure to everything, and that you can trade throughout the trading day, just like a stock. That is an ETF, an exchange-traded fund. What is an exchange-traded fund? An ETF is an investment product made up of a basket of securities. The most common form of ETFs track an index for a whole country or sector. Think of it like this. If a fund and a stock merged, the result would be an exchange-traded fund. Like a fund, an ETF is diversified. And like stocks, you can buy them easily through your broker, and you can trade them throughout the trading day. ETFs are new in the Middle East, but they've grown in popularity around the world for more than a decade in both bull and bear markets. Today, investors around the world choose ETFs to structure their portfolio. In fact, the world's most traded security is an ETF that tracks the S&P 500. Investors own more than $3 trillion in ETFs, and in 2015, the level of assets in ETFs surpassed those held by hedge funds for the first time.